Hello and welcome to 5 Things Investors Need to Know This Month. I'm Valerie Leonard, CEO and founder of EverThrive Financial Group. And in a few quick minutes, I'll give you an objective view of October's topics, including the presidential election, geopolitical tensions, inflation, and more. So let's dive straight in. First, I want to start by talking about the housing market. We're seeing potentially an early trend of more people tapping into their home equity, which is essentially like using their home as an ATM. And this could lead to some consumer health risks. So we're going to watch that. But we're also flagging home starts as something to watch. And home starts is essentially the number of new houses that are starting to be built in a given month. And you can see from this chart here that the rates of private housing unit starts are beginning to decline. And then supply chain issues, construction costs, and potential reinflation are not helping. Now, we're going to talk more in a minute about inflation, but first, I want to mention the connection between the housing and labor markets. Last month, we talked about the fact that the labor market saw a higher number of layoffs and a lower rate of hiring in the month of August than what we've seen in over a decade. The construction industry, unfortunately, was particularly affected with a slowing number of new home starts, which I just mentioned, but also declining builder confidence. The Fed cut rates by 0.5%, and they were likely focusing on the labor market, but they've got a balancing act on their shoulders, and potential rate cuts make room for higher inflation. And there's an overlap and an integration with all of these factors, which brings us to another related point about geopolitical crises. Now, everyone that's watching knows that tensions in the Middle East are increasing, and I've been asked a lot of questions about this impact on the stock market. And this is where a long-term investment strategy comes in. On average, stocks perform somewhat better after the onset of a global crisis, while safe assets such as U.S. Treasuries, for instance, have historically sold off slightly. Now, as you can see in this chart, the average performance of the S&P 500 3 months and also 6 months after a global crisis has been positive. And it's likely that non-crisis factors were the performance drivers. So to give you an example of that, in 2008, the global financial crisis was, of course, a bigger driver of performance in the market than, say, Russia's invasion of Georgia. But the bottom line is that the overall health of the economy and the outlook for industries and their earnings matter more than isolated geopolitical events. But there is a question about inflation. What we're going to keep an eye on is the potential for geopolitical events to raise the price of oil, unfortunately, right? Because this could cause inflation to creep back up. Now, here in the United States, the supply chain disruptions caused by hurricanes Helene and Milton could also potentially drive up prices and make inflation tougher to tame. And the Fed, of course, has said that they're going to lower interest rates, but keep in mind that reinflation could affect their current thinking. Now, the presidential election is just a few weeks away, and we understand that, of course, there are concerns. From an investment perspective, there are 2 things that you need to know. Historically, there is some market volatility in the months before and after election day, and then it normalizes. So as you'll see here, this red arrow shows the spike in average volatility in the last 10 elections, and then the blue arrows show the relative calm 50 days before and 50 days after election day. So in short, some additional volatility right now is to be expected, but markets tend to largely ignore the results of elections. This is likely due to the fact that a new presidential administration or maybe a major change in Congress doesn't tend to impact markets in the first 2 years of a presidential term. Markets are more likely to be affected by political policy in the latter 2 years of a presidential term. Also, a comparison of presidential election years and non-presidential election years shows that there is no statistical difference in returns for a 60% stock slash 40% bond portfolio. And we call this a balanced portfolio because it's not aggressive, it's not conservative. It really represents an investor who wants to take a moderate amount of risk. Now, we all know that past performance is not a guarantee of future results, but this data does go all the way back to 1860, and it's a strong directional indication that the election is likely to have minimal impact on investors' portfolios. That's it for today. Please hit the subscribe button on YouTube to follow us, and we will see you again. Thank you so much for joining us today.